I wanted to welcome everyone to today's webinar. We're covering a fascinating topic of financial planning strategies for small business owners. So I know that on the call, we have a number of individuals in different industries. So one question, by the way, we are using the chat window quite a bit. So maybe you can type in what industry are you in, or what is the business that you are thinking of starting or started or thinking of taking to the next level. A quick disclaimer that I do before every financial webinar. This is not tax advice. This is not legal advice. This is not financial planning advice. This is a webinar for general information only. And for your specific situation, feel free to reach out to the specialist that you're working with, whether it's a financial planner or an accountant or your lawyer. And the first question that I'm going to ask everybody on the call is, there is a statistic of 59% that's associated with small businesses. Do you know what that is? Or what do you think this can be? And we'll just give it a minute for people to share their ideas. %59% connected to small businesses. And what can it be? And yes, of course, it can be a lot of things. And the short answer is close. The short answer is business survival. So if the question is, how many businesses still exist at a 5-year mark? The answer, at least according to the most evolved study that I could find, the answer is 59%. Now, I do not know how they measured businesses. I don't know how they measured survival of businesses. But one of the reasons why I wanted to bring this up is because I would like all of you on the call to be in that 59%, and maybe we can inch the number a little bit higher. So on our agenda, we are going to cover a lot of things. So it will be a fairly fast-paced type of a webinar. We're talking about sole proprietorship strategies. We're talking about corporation-specific strategies. There will be time for Q&A. And my goal is to give you a bit of an overview as to, as a small business owner, what are the things that you can be doing? What are the things that you should be doing? Arguably, what are the things that you must be doing in order for you to survive, in order for you to make it to the next level? And just a bit of an introduction. My name is Alexei Schwartzman. I'm a financial planner. I've been running Schwartzman Financial since 2010. So we just had our 15-year anniversary. And we are holistic, which basically means we do different things for our clients. We deal with investments, we deal with insurance, we deal with taxes, we deal with corporate taxes, personal taxes, payroll, bookkeeping, etc., etc. So in today's webinar, I will be jumping quite a bit from financial planning to taxes, with the goal of, with you being a sole proprietor or a corporate owner, what are the things that you can do to survive, to thrive, and take your business to the next level. So the first strategy that I share with everybody, and by the way, I have a whole other webinar on the topic of taxes for the self-employed. Okay, and if any of you are interested, we can share the link with you. But one of the things that we cover in a lot of details, because the very first thing you need to think about as a business owner is tracking your income and your expenses. And the question is, as a business owner, do you know all of the deductions, all of the things that you can deduct as part of your business journey? And are you deducting them? Are you deducting them in the right way? Because there are certain rules that apply to certain categories. And I find oftentimes with business owners, people are pretty good at tracking their income, because income is easier to track. You have a bank account, or you have, let's say, your PayPal account or your Stripe account. But when it comes to expenses, not everybody does as good of a job as they can. And yes, it can be a bit of a pain in the neck to track all the receipts, to track all your, let's say, business driving, etc., etc. But this is the best way for you to pay less tax. That is tracking your business expenses, tracking your income. If you are doing a good enough job at that, Fantastic. Then we can talk about another strategy that may be of benefit to you. So everybody on the call has their own business. How many of you contribute to your RSP? Okay, for a lot of people, this is a viable strategy. And in particular, I see this, we have a lot of clients who are in the IT world. And in the IT world, as an example, you have certain expenses, but once your fixed expenses are set, or once your business is running, for you to acquire each new client costs very little. So your income over time will go up, but your expenses are going to be fairly low or fairly stable. And oftentimes business owners, especially in the information technology area or in consulting, oftentimes your income is very large, your expenses are very small. Therefore, the net income or the taxable component of your income is going to be very large. So what can you do in order to pay less tax? The answer is using RSP. Putting money into your RSP, it's a deduction from a tax perspective. Deduction is something that lowers your income. So when you put your money into an RSP, your income is lowered, and therefore you end up paying taxes or less taxes. And the benefit of the strategy is the tax that you pay to Canada Revenue Agency, either in April or quarterly, whatever your situation is, that tax is gone. When you put money into an RSP, you end up paying less tax to Canada Revenue Agency, and the RSP is yours as part of your retirement planning strategy. So RSP optimization is a really good approach, really good strategy, especially if you're in a situation where you have lots of income, not a lot of expenses. Okay. Next, I don't know if any of you use a tax reserve strategy. And we call it tax-free TFSA optimization and tax reserve. By the way, those of you who may not know, TFSA is a tax-free savings account. All of you, and I know all of you are in Canada, so all of you have room in your tax-free savings account. And we oftentimes use a TFSA as a tax reserve. What does that mean? When an individual is earning income, they take a certain proportion of that income and they put it aside. And if they have room in their tax-free savings account, they can put it into their TFSA, and they can invest it into within the tax-free savings account. And when we talk about investing, we can just use a high interest savings account. So we're not talking about volatile type of investments. So the money can stay in a tax-free savings account. The money can grow tax-free. When it comes to April, the client takes money out, the person takes money out, pays off the tax, no problem. And then you repeat the cycle year after year up until the point where CRA starts requiring you to pay taxes in installments. So basically every 3 months. And incidentally, you can use this for installment payments as well. So the idea would be whenever you get paid from your clients, take a certain portion, put it aside into a TFSA if you've got room. Then when it comes time to pay your installment, take the money out, pay your installment, and you're done. Can be a very effective strategy. The most important element of this is the tax-free element, because the growth in that account would be tax-free, and that's what you are after. Next strategy has to do with FHSAs. So I don't know how many of you on the call are owners of your own home. But if all of you are, fantastic, congratulations. But if some of you are thinking about purchasing your own home, then FHSA could be a viable strategy for you. FHSA is a fairly recent financial tool, only been brought in 2024. And it is a first home savings account. When you contribute into that account, and by the way, contributions are $8,000 per year for 5 years. But contributing money into your tax-free first home savings account is considered to be a tax deduction, so it lowers your income. And by the way, any growth is tax-free. So this money you cannot use to pay off your taxes, but this is the money that you can use in order to build up your down payment for your purchase of your first home. So if some of you on the call do not currently have your own residences and you are a business owner, this might be an idea for you. Next, I don't know how many of you use your family or pay to family members in order to run your business, but this can be a viable strategy. Once again, I'm going to take you to an example of an individual in the IT world or in a consulting world, lots of income, not a lot of expenses. So potentially by hiring a family member, this is a strategy that you can use. Now, of course, you do need to legitimately hire a family member. Ideally, they would be over the age of 18, not necessarily, but ideally. The age of 18, those of you that have corporations, there are certain rules that kick in. They're called TOSI rules, or tax on split income rules. So there are a few requirements for it. So if you have a corporation and paying family members, it's a little bit trickier. For those of you who are sole proprietors, income splitting could work. So when you hire somebody within your family and you pay them, that becomes a deduction for you. Now, that becomes income for them. So that is also something to consider, but it could work. And it could work with family members who are young. I have clients who are using their 15, 16, 17-year-olds, but there is work that's being done by the kids. And yes, the kids invoice the client, and yes, the client pays them. So it is basically finding a subcontractor for your own business. Next, capital cost allowance planning. What is that? So capital cost allowance planning is when you purchase equipment for your business. And equipment we're talking about, so anything greater than $500 could qualify as a capital. So capital cost allowance is basically depreciation. So most people kind of have an idea of depreciation. And the way depreciation works is if you buy, let's say you buy a cell phone for your business. Okay, a cell phone, let's say, costs $1,000. So you do not deduct the full cost of a cell phone as a business expense. Okay, why? Because a cell phone is going to provide long-lasting value to your business. Therefore, there are certain rules as to how much can you deduct in your business. So first year, you are able to deduct, let's say, 10%. Second year, you're able to deduct 20%. And then every year you deduct a certain portion so that over time, the value that the phone is providing you is reflected in your business schedule or business expense schedule. There are certain things that you can do with capital cost allowance planning. So for instance, if you buy an item at the end of the year versus the beginning of the year, oftentimes you can buy something at the end of the year and you can get a deduction or a portion of a deduction for the whole year, which basically means that if you're thinking about buying equipment, so sometimes planning, do you want to buy it in the beginning of the year or at the end of the year? Sometimes just by planning it in a certain portion of the year, you can use the deduction even if you bought it, let's say, on December 29th, for instance. There are a number of little caveats that you do have to pay attention to, but that could be a valuable strategy if you are thinking about purchasing large items for your business. Next, and one thing I also wanted to mention is if you have any questions, by all means, put them into the chat, and we will be addressing all of your questions, or as many of your questions as we possibly can. So on the sole proprietor side, there are a couple of other strategies that will come. You will see that will be of benefit to you. But on the proprietor side, there is not much you can do. With corporations, there are a few more strategies that you can potentially benefit from. Okay, I do know that at least one individual said that they are considering to be incorporated. And what is a corporation? So a corporation is a separate entity from you. Because as long as you're a sole proprietor, from a tax perspective, from a legal perspective, you are the business and the business is you. And you can have multiple businesses, by the way. You can have 5, you can have 20, you can have, it doesn't matter. There is no limit to how many businesses you've got. But from a tax perspective, you are the business is you. So all of your income and all of your expenses are on your tax form, they affect your tax situation. If you were to incorporate, a corporation is a separate legal entity. A corporation is a separate tax entity. It has separate rules, different rules from you as an individual. You could be an owner of a corporation. You could be an officer in a corporation. You could be a shareholder, owner slash shareholder, pretty much the same thing. You could be an employee of your corporation. And in every situation, the rules are going to be different. So one of the questions that comes up for many sole proprietors, and I know for any of you on the call who are sole proprietors, this will be a question: should I incorporate? Okay, or when should I incorporate? And there are a number of answers. It's not a black and white type of a question. The answers generally depend. So one of the questions is income. Should you incorporate when you reach a certain income? Okay, and the answer is not necessarily. But yes, the higher your income is, the more benefit there can be from your corporation. And we should mention that in BC, the tax rates, especially for higher income earners, the tax rates are pretty high. So the top tax rate in BC is 53%. Okay, so imagine you are employed as an IT individual. So let's say I have lots of clients who work at Microsoft or Amazon. Let's say you work at Microsoft, and then you decide to do certain consulting on a side. So if you work at Microsoft and you're already making, let's say, $250,000 for the sake of argument, that puts you in a top tax bracket. So any extra dollar you earn from your company is going to be taxed at 53%. So the question of when to incorporate, then income is a factor, not the only factor, but is a factor. Then there is a question of liability. What are the chances of you being sued by your unhappy clients? And as the chances go up, then potentially having a corporation may be of benefit to you, even if your income is not very high. And maybe in the chat window, I understand. So in terms of businesses, yes, I can see there is a photography business, there's an interior design business, there is a consulting on technology and construction business. When you think about the likelihood of you being sued, so if you're a photographer, for instance, the likelihood is not very high. But if you're designing technology in the construction business, high costs, and there is a fairly the chance of being sued is much higher. Therefore, having liability can be of benefit. What does liability give you? If there is a lawsuit, heaven forbid, but if there is a lawsuit, then if the person is found liable, then whoever sued them can go after personal assets. So if a person has a house, and if the person has an RSP, if the person has a tax-free savings account, etc., they get sued and they're liable, and now they have to compensate the victim, so to speak. And this compensation is a fairly large amount, then potentially the person's house, TFSA, RSP is on the line. If a person has a corporation and the corporation gets sued, then it's the corporate assets that are on the line, and personal assets are protected. So liability can be an important factor. And the third factor is requirement. So in certain jobs, you are required to incorporate. And we see this a lot with our engineering clients. So if you're an engineer, oftentimes due to certain qualifications, restrictions, etc., then a company would not hire you as an engineer, as a professional engineer, unless you have your own corporation. Okay. And going back to the topic of income, there is no certain threshold of income where a corporation would be of benefit. Where we do see it playing a role is if you do not need all of the income from your company. So let's say if your income from, going back to my Microsoft example, a person is making $250,000 a year and they consult, and let's say they make another $100,000 consulting, and let's say they don't need that $100,000. If that's the case, they can leave $100,000 in the corporation, not take it out. What would be the benefit? The benefit is at top tax bracket in BC is 53%. Corporate tax rate is closer to 11, maybe 12% for small businesses. That basically means the person or the corporation would pay 11% of tax on its income, and the person doesn't have to take it out. That's the way the frame. So the deferral of taking the income out is a very powerful element in deciding when to incorporate. The other important element is when you are incorporated, you can decide. Do you want to pay yourself a salary? Do you want to pay yourself a dividend? We don't really need to go into the details because there are not many of you on the call that have corporations, but you have the freedom. And there is a tax difference in salary versus dividends. Why? Because the dividends are, the corporation has already paid the tax. So the owner is not going to be paying tax twice on it. Now they will need to pay some tax, but they will be paying a smaller amount of tax. If you are a corporate owner, you also need to think about your investment portfolio. So we do see this quite a bit, and maybe yeah, maybe this is not a question for you, but think about your own. How much money do you have in your business? Okay, because if you have, let's say you have, I don't know, $20,000 that you have saved inside your business. If it's inside your corporation, that $20 or that $20,000, if it's in a bank account, the corporation will be paying almost 50% tax on that income. You also need to think about it from a perspective of a sole proprietor. Imagine you have $20,000 in a bank account, and that bank account, let's say it's a high interest bank account, the interest income from that bank account is you are paying, well, depends on your tax bracket, but you're paying the most amount of tax. And the question then becomes, how much tax can you save by using a tax-free savings account, by using your FHSA, for instance? There are certain ways where you can invest money and you end up paying less tax. So taxes inside a corporation become a very, especially it's called active income versus passive income. So if you are a consultant on technology in construction and you have your own corporation and you have money inside your corporation, the corporation will be paying almost 50% tax on the interest that you're receiving from that investment. If you're a sole proprietor consultant on technology in construction, and depending on your income, you might be paying 30%, 40%, maybe even 50% or 53%, which is the top tax bracket. So the tax implications of the money that you have saved after your business are obviously a very important element of how successful your business is going to be. I know there are not a lot of you who are incorporated on the call, so this strategy may not work for you, but there's a whole strategy of shareholder loans. So you can basically, if you are a shareholder of a corporation can give you a loan, so you can pay yourself in a way so it won't be a salary, it won't be a dividend, it will be a loan. And there's certain tax, I don't want to say benefits, but there's certain caveats and certain rules that you have to pay very close attention to. It can be a very powerful strategy, but you need to know all the caveats, which we are not going to cover because most of you, once again, are not going to benefit from it. For those of you that have corporations, and for those of you, so this, we have seen this with sole proprietors. So this is something that could potentially be of benefit to you, but the benefit is much more in a corporation. So these are health spending accounts or health and dental plans. So you can set up a health and dental plan inside your company. It works better if it's inside a corporation because it becomes a deduction for the corporation. So it becomes an expense. For a sole proprietor, if you have a private health and dental plan, the premiums that you pay for that plan, so whatever the monthly amount that you pay for that plan becomes deductible to you as a business expense. So if you do not have any coverage, and especially if you have a family to support, especially if you are the primary income earner in your family, then having a health and dental plan could be an option for you. Now, for sole proprietors, they are fairly expensive, or they can be fairly expensive, because the way health and dental plans work is the more people you have on it, the cheaper it becomes for everyone. If you have a health and dental plan only for a business owner and maybe the spouse, assuming both are in the business, then it's not necessarily economically viable. But this is one of these black and white situations where you can look at your medical expenses, you can look at your health and dental plan, you know how much your health and dental plan will cover. So you can run scenarios, and you can see, is it worth doing it? Yes, as a business owner, you deduct how much you're paying for it. And you can also deduct medical expenses with certain rules. So it can or cannot, or it can be a viable strategy. But for sole proprietors, we can actually run some calculations to see if this is something that's going to be really of benefit to you. The other strategy that we do see, particularly with businesses, is lifetime capital gains exemption. Okay, it's a mouthful. LCG is the abbreviated version. This is a very, very powerful strategy, but this is only for corporate individuals. What is this? If you are a business owner, and if you, let's say you've built your business, let's say you're a consultant, but you now have a team, you have an office, you have equipment, etc., etc., and then one day you decide to sell your business. If you meet certain criteria, we don't need to go into the criteria. There's a whole bunch of criteria you need to meet in order to qualify for this. But the lifetime capital gains exemption basically says, let's say you sell your business for $1 million. How much tax will you pay on it? Zero. Okay, and by the way, this year the LCG is even more than $1 million. I don't remember the exact amount, but it's a bit more than $1 million. So if you were to sell your business for, let's say, $5 million, that basically means on your first million, you pay zero tax. Okay, and paying zero tax on $1 million, that's a lot of money. So we've had a few clients who used or who benefited from the LCGE. Bottom line is, if you are incorporated, if you were to sell your corporation, before you do, talk to somebody, talk to your accountant, because this can save you hundreds of thousands of dollars, just this one thing. Okay, unfortunately, sole proprietors do not qualify for this. And the other thing is, you can see, so sometimes in your CRA account or in your tax documents, you can see it'll say lifetime capital gains exemption, whatever, $1 million. So sometimes people see capital gains and they think, oh, I can use this. Unfortunately not. You can only use this if you are a business owner selling a business. Actually, not true. You can also use this if you own a farm and you sell your farm. Okay, but those are pretty much the two situations. And if, as an individual, none of us are exempt from capital gains, so there's always a question of how do you reduce the tax that you pay on capital gains, which is a whole other discussion. This is also a corporate strategy, but charitable giving. Okay, whenever you give money out of your own pocket to a charity, you get a charitable receipt. That's great. It's a tax credit. Fantastic. You end up paying less tax. If you donate through your corporation, then it becomes a deduction for the corporation. So it actually lowers your income. So if you have a corporation, giving money to charity is even more powerful and more beneficial for you compared to you doing it as an individual. But this is something that's well known. And I find most business owners are actually aware of this. So I have lots of clients who donate through their corporations as opposed to doing it through their personal account. One strategy that will be of benefit to all of you is an annual review or annual tax planning review. What is that? So that's a strategy where at the end of the year, or typically earlier in the year, so usually January, let's say mid to late January, looking at your numbers, looking at what was your income, what were your expenses, should you put money into an RSP, should you put money into a tax-free first home savings account? If so, how much should you be putting? Because so an annual review gives you a little bit of flexibility in terms of planning. Okay, oftentimes when you think about doing taxes, and usually people think about doing taxes around March, April, because that's the deadline being April 30th for your payment to CRA. The issue is by that point it's too late. So if you are thinking about an RSP strategy or an FHSA strategy, then this is something that you need to do before the end of April. Okay, and actually, sorry, I misspoke. RSP strategy, the deadline is end of April. For FHSA strategy, actually, no, the deadline is December 31st. So if you're a homeowner and you're using your FHSA in order to purchase your home and you're a business owner simultaneously, then potentially having an annual review closer to the end of the year, or maybe early December, mid-December, what would be much more beneficial for you than doing it in the following year. And then the question becomes, and this is not exactly a quiz, but of these strategies that we've discussed, now some of them will not be applicable to you if you don't have a corporation, but of these strategies that you've discussed, that we've covered, how many are you using already? And by the way, feel free to put this in the chat. And how many do you think you could use? So this is a quick summary, because the bottom line is, as a business owner, you have certain tools at your disposal. Now, there may not be many. If you have a corporation, you do have access to more tools, for sure. But corporations are more complicated, they're pricier, they're more costly to run, to manage, etc., etc. There are more rules that apply to them. But as a sole proprietor, yes, you have certain strategies that you can be benefiting from. And my question to you is, how many of you are you using? And how many of you do you think you can be using or should be using? Okay. And over what we are going to do as we are coming to an end of the presentation, we are going to open up for questions. I wanted to give you a quick reminder. We are going to send you a quick survey regarding this presentation, and to see if you could benefit from some of the other services that we provide, including a free consultation regarding your own business, to see if you could benefit from these strategies that we've discussed. So on that note, so when you see the post-webinar survey, please fill it out. It would only take you a couple minutes, and we would appreciate it. If you would like to connect with us, here's our contact information. And I am looking forward to answering your questions. Those of you who need to go, great. Thank you for joining us. I hope you found this of value. And those of you who have questions, you can either unmute yourself or you can use the chat window, and we will try to address any questions that we have or that you have for us. And by the way, yes, and I forgot to mention, so Corey, who is my assistant, you would have met him earlier. Thank you, Corey, for helping me to run this webinar. And Corey, if I'm going to ask you to, let's unmute you, and then if you have any questions, yeah, by all means, feel free. And I did want to mention, yes, thank you, Corey, for the reminder. We do have another webinar on September 17th. That one, we're dealing with advanced investment strategies. So those of you, some of you may have already registered for it, but if you're interested in learning some of the advanced investment strategies, join us September 17th, same rules, it's free, about the same time. In the meantime, are there any questions that you have regarding your specific business or anything else that we've covered? So the question is, can I take RSP during a year to invest into a business? What are the conditions? It's a great question. So RSP stands for Registered Retirement Savings Plan. Okay, and by the way, I have a whole webinar on RSPs, which we usually do around February. We can talk more about it, or I can send a recording to any of you who are interested. RSP is your own Canadian pension plan. When you put money into an RSP today, it gives you a deduction, so you end up paying less tax. And RSP, you can use your RSPs when you retire. You can start taking the money out. But between now and then, that point could be at 65, at 70, up to 70. You can take your money out at any time. But the growth of your money in your RSP is completely tax sheltered. So you don't pay any taxes on the growth, which gives you, which is a very powerful tax advantage. And then when you get to a certain age, or when you decide to take the money out, you can start taking the money out. If you're using RSP as a short-term strategy, it's not a good strategy at all. Why? Because anytime you take money out of an RSP prematurely, so basically before 65, there are tax implications, and usually these tax implications are painful enough where you don't want to use your RSP prematurely. Okay, but by the way, you can use your RSP in order to purchase your home, okay, as part of your down payment, and you can use your RSP in order to go back to university or college. You, when I say you, I mean you or your spouse / partner. So RSPs can be used for these three things: retirement, purchase on a home, and higher education. But if you want to use it as a strategy as a business owner, so the strategy would be you use it now to reduce your income, and then you don't touch the money up until you're whatever 65 or 70, then take the money out. Now, in the meantime, you end up paying less tax. In terms of the timeline, you can contribute to an RSP anytime, okay? But any contribution between March 1st and March 1st of the following year, so it's basically March to March, any contribution within that time frame is attributed to the previous year. So any contribution you make between now, we are in August right now, August up until February 28th of 2026, any contribution that you make is going to be counted towards your 2025 tax year. Any contribution made after March 2nd or 3rd of 2026 are going to be towards your 2026 tax year. I hope that answers the question. Next question, what are the advantages of being a sole proprietor aside from service flexibility? And yes, there are so many advantages for a corporation. There are lots of advantages. And one thing that I'm seeing, and we're going to see a lot of it, because the rules of the world have changed. And in 30, 40, 50 years ago, the rules were you go to school, you get post-secondary education, maybe you get your college degree, university degree, you get a job, you work on that job, you retire, live happily ever after. That was the business model. Okay, that business model is completely out of the window, and that business model has been, if there was any of it remaining hanging on the window after COVID, none. Like you can forget about that business model completely, entirely. After COVID, what we've noticed is a lot of people are going, like they don't necessarily switch completely to sole proprietorship, but they start side projects. I have lots and lots of clients that have side projects. And I guess part of the reason is because our business model is such that we deal with a lot of financial issues for clients. But sole proprietorships or your own business is going to be your key to success. I fully believe that. And by the way, now that AI is starting to replace jobs, we're going to see a lot more of that. And AI is both a blessing and a curse. Those of you who are on the call, I highly recommend for you to start learning how to use AI, because businesses are going to be laying people off simply because some will be replaced by AI. Some will be replaced by people who know how to use AI. And the advantages of being a sole proprietor, number one, it's your business. You charge, you do the services that you want, when you want, how you want, you charge however much you want. You can deduct certain expenses. Those of you who work from home, especially if you're renting, you can deduct a portion of your rent. You can deduct your using of your vehicle, etc., etc. So this is going back to what I mentioned before, tracking all of your business expenses. But generally, I think the whole model of 9 to 5 is slowly being phased out. COVID contributed a lot to it, but I'm seeing a lot of individuals, and just about everybody on my team, they work when they want to work. And partially it's because it's more challenging now. Children, if you want to take care of your children, so having that flexibility is amazing. And there are lots and lots of advantages of being a sole proprietor. And I would say this is going to be the way of the world. I'm not just talking about Ubers and DoorDashes, but I'm talking about any person that will be able to start their own business, they will be. And we will see an explosion of their own businesses. Absolutely. Great question. Any other questions? because if there are no other questions, feel free to reach out to us. Or so if there are questions, feel free to reach out to us. But other than that, thank you to everybody for joining us. And I wish you a productive rest of your day. Thank you.